Hello, and welcome back to CoValue app tutorial. Let's move on to submodule Decrypt Stock Value and PE of the Perception module. Decrypt Stock Value and PE will help you iterate and determine what PE drivers are built into the stock price of a company. This module is primarily used to decode values and PE multiples of banking, financial services, and insurance companies. The module uses discounted future earnings model to value companies. Users have an option to either create a valuation plan from DataBank or edit an existing Decrypt PE valuation plan or create a valuation plan without DataBank. Here, we create a valuation plan for American Express from the DataBank. We can change country DataBank to the respective country or exchange where the stock is listed. Here, we change DataBank country from India to USA and select American Express to value and proceed after naming the plan as on the day it was created. This example is just an illustration for the tutorial to understand the working of the app. Let's name this plan as on the date of undertaking this valuation, that is 17th December 2022. On importing this from DataBank, all the historic information, macro information, analytics, number of outstanding shares, and computation of cost of equity is pre-filled into the app for the respective company. The data pre-filled is classified, and the user does not have to look or classify any data. This process assists the user to conduct speedier valuations. In this screen, all the basic information, such as prior period, currency, number scale, and outstanding shares, is pre-filled from the DataBank. Users can distinguish their work by naming the valuation plans as they wish. You may refer to the tooltips, denoted by the eye icon, for better clarity for using the app. This is located on top right of every screen. Advancing to the PE drivers screen. There are two scenarios, price and value, where PE drivers must be entered. The market price, PE multiple, and EPS, as on the previous trading day, is pre-filled. In the price scenario, the PE drivers must be iterated in a way that the equity value per share computed based on value drivers at the bottom of the screen equates with the market price at the top of the screen. This will assist you to analyze what is built in the current market price. In the value scenario, PE value drivers need to be entered based on user assumptions. The equity value per share computed here will assist you to analyze the gap in price and value. Let us now enter the PE drivers for both the scenarios for the forecast period. Initially, we shall enter the PE driver assumptions same for both the scenarios, and then we'll iterate and analyze what is likely built in the current stock price, and then change the assumptions for the value scenario as per user assumptions. Users can refer to history icon on top right corner of the screen to view the U.S. Treasury bond yield for 10, 20, and 30 years. For American Express, let us initially take a forecast period of 5 years for both price and value scenario, followed by the risk-free rate, which is 3.49%, as per the latest 10-year Treasury bond yield as on the date on this exercise. Users can refer to history icon on top right corner of the screen to view the U.S. inflation for up to 30 years. We have assumed expected inflation rate to be 3.25% during the forecast period. The expected inflation rate should be less than the risk-free rate. There is an alert if this exceeds the risk-free rate. The user may wish to proceed despite this alert. As you can see by clicking the EPS under History section on top right of the screen, American Express had a 166.31% of EPS growth for last year and has been compounding its earnings by 12.1% during the past 5 years and 9.2% during the past 10 years. Let us assume a 6% compounded annual growth rate of EPS for the next 5 years for both the scenarios. Cost of equity is 10.75% as per the app. For forecast period, we increase the risk or beta of the stock assumed at 1.09 to 1.14 and recompute the cost of equity, which now come to 11.08%. We enter the cost of equity as 11.08% for the forecast period. Advancing to the terminal period assumptions. The earnings of the company continue post the forecast period and thus have value. Terminal period assumptions helps to forecast the earnings into perpetuity. In this section, you need to enter your cost of capital and terminal growth assumptions. The assumptions entered initially will be the same for price and value scenarios. You will need to enter the expected inflation rate expected during the terminal period. The user may click the history icon to check the history and CAGR of inflation for the currency for up to 30 years. Here we take 2% as the expected inflation rate during the terminal period. Ensure that the risk-free rate is greater than the expected inflation rate, as generally, the Treasury yields should incorporate the expected inflation rate. Here, we take 2.25% as the risk-free rate during the terminal period. This is assumed as inflation of 2% plus real interest rate of 0.25%. Enter the cost of equity during the terminal period. Users need to refer the history icon to view computation under Capital Asset Pricing Model in the Price and Value column. Do review the beta with other websites. Users can also deploy other models or just use expected market return, which is an implicit rate of return the investors expect in the stock market. The cost of equity for American Express is computed at 9.5% as computed by the app. However, we have increased the risk or beta from 1.09 to 1.14, and thus the revised computations come to 9.83%. Before you enter the terminal growth assumptions, you will need to be clear how you want the earnings to grow. If you expect the earnings to grow at terminal growth rate, then enter the inflationary growth and real growth assumptions. Or, if you want the earnings to grow at expected inflation rate, then enter only the inflationary growth, then enter real growth assumptions as 0. Or, if you want the earnings to remain constant, then enter 0 for both inflationary growth and real growth. The inflationary growth should be in line with the inflation rate assumed during the terminal period. This essentially is the pricing power of the company and its ability to keep up with inflation. The user should refer to the inflation entered during the terminal period. Here, we assume American Express inflationary growth will be 2%, which is as per the expectations entered during the terminal period. The real growth expected into perpetuity should take into account the country GDP growth rate, industry growth rate, and the world GDP growth rate. The user may click the history icon to check the history and check the CAGR of GDP growth for the country and the world for up to 60 years. Here, we assume American Express real growth in earnings to be 1.5%. You will need to ensure that the terminal growth rate is not greater than the cost of equity of the company. Now let's compute. As you can see, the equity value is higher at $154 per share than the current market price of $146 per share. So we need to iterate PE drivers to equate the equity value per share to current market price. This time, we iterate the net income CAGR to 2.25% and compute. The equity value comes to $149, very close to market price as on the date of valuation. Now we know what's built into the stock price of American Express. The market is discounting a compounded growth of 2.25% for 5 years. As we had kept identical assumptions for both price and value scenarios, we need to change the PE drivers in the value scenario based on our assumptions to analyze the gap in price and value. Here, we revise the forecast period to 10 years and net income CAGR from 2.25% to 7%, and cost of equity to 10.75% for the forecast period, and for the terminal period, we change the cost of equity to 9.5%. Users can also use their own expectations of returns to arrive at a fair value and change it to understand the impact of cost of equity on the equity value. Now, when we click Compute, we have an approximate scenario in front of us that clearly shows the gap between price and value of the stock. The shareholder value of American Express comes to $220 per share compared to current market price of $146 per share, indicating that based on the PE drivers assumed, the stock is undervalued. In this screen, you can view the equity value per share and 1-year PE forward based on the discounted earning model for both scenarios. Users can also view the Decrypt stock value and PE reports for each scenario. Users can email the reports from here and share the valuation plan with other subscribers of the app in the app format. Thank you.